Hello, welcome back. I have a confession to make. NIO is a company that I always wanted to add to my portfolio, yet I haven't found the actual time to do that. And at some point, it's been a couple of years or so, I don't remember exactly, but I actually wanted to add NIO to my portfolio when it was near $6 or so. And I kind of thought about it, it was a little bit of a leap of faith back then. But right now, as we have much more data about NIO and as it has gone up and down a lot, it's worthwhile taking a little bit of a closer look and see whether it's a potentially interesting opportunity. I think I wanted to add it about, I think it was back in 2020 or so, maybe around these levels, could have been a little bit lower even. But yeah, this is when I was looking to add it, I didn't. It just turned out to be a mistake, I suppose. But it was a mistake because of the sentiment and not really because of the company's financials. That's the thing. So was it really a mistake? Not really. It was mostly like a trading mistake, if you could say that. But as you are looking at it right now, the stock price is going down and down and down, almost 80%. And I will never be buying a stock just because it's going down and it was sitting at a much higher price, and there is a lot of hype around it. I don't do it like this. Although if we're talking about a cyclical sector, I could do it like I have done it for Carnival Cruise, for example. A little bit of a different play. I have done it with US Steel, in which I actually made some very good money too. I more than tripled my gains there, and so my capital. And so sometimes you could be finding some companies that are slightly elevated based on their current price, but then again, it may be worth a little bit of a risk. It really depends on what you are having in your overall portfolio and how much you want to be adding at stake in order to potentially maybe get a multi-bagger. But then again, I won't just invest in a company randomly. It's not going to be just a random company that's not making any money. It would still have to be a company that is close to value. And even if it's not making a lot of money, I would still want it to buy the company when it's around its value price. And so this is what I'm going to be looking at with NIO over here in this video. Now again, NIO has been battered down extensively, and you will see its P ratio is negative. It's been losing money, and price to free cash flow ratio is actually marginally positive, yet it's pretty high still. Insane dilution over here, as you'll see, and free cash flow compared to total liabilities is also pretty high over here. Now, the good thing is that we started with zero, that's why you're looking at infinite here, but if you'll see that the company has been increasing its revenue like crazy, so of course that's a very good thing, yet the net income growth has been very stagnant, just a little bit, and seems to be in a little bit of an upwards trajectory, which is at least good. The free cash flow growth is a little bit better, but the total equity growth is also increasing because of these outstanding shares having been issued from the company. Now margins are negative, the company is losing money at the moment. Yet, I want to take a little bit of a closer look at what is going on with the statements here, the data that we have. And of course, the great thing about the company's revenue, the revenue has been increasing all over the place, and the net income, though, is negative. Now, it has been more negative in the previous years, but it's still negative. So we are looking at a company that is losing money, and so it would have to take a leap of faith for me to enter this company, and I would have to buy it at a very cheap price. I wouldn't just enter at any price. This is very crucial to examine with the stock evaluation tool, like super crucial, because we cannot really deduce what kind of price it makes sense to pay. $13, $20, 25. We really need something more concrete, and we're going to do that next. But first, let's take a look at the balance sheet. The total equity of the company has been increasing. Remember, additional paid-in capital is the reason. 12 billion, 14 billion, 5 billion. Company has been issuing shares like crazy, and this is how they're making their equity. Now, if we take a look at the cash flow statement here, you will see that the net cash provided by operating activities has been increasing in the past year or so, and you have to remember that net income was negative in all of these years, and so the reason why this becomes positive is all the surrounding factors, like the change in working capital, for example, here, which is more than likely a one-time thing, and a little bit of depreciation and amortization. So we're probably looking at a more negative value for the next year. So Cash from investing activities, you will see that is in the negative. The company has been investing a little bit. And the cash provided by financing activities is positive because the company has been grabbing some more extra debt and issuing shares as well over here. So the free cash flow, as you'll see here, is marginally positive right now. Overall, we're talking about a company that has some money in the bank as well. A lot of it came in this period, as you'll see, because the cash at the beginning of the period was 151 billion. So they basically issued shares, and this is how they're having the extra cash at the end of the period. They really diluted the investors lately, so that's a very bad sign. They needed the capital, I suppose. And so now I want to take a look at the stock evaluation tool. And again, remember, we're talking about a company that is losing money, and that's a big problem. You will see the nice thing. Net income margins are creeping towards profitability, as you'll see here. Minus 100, minus 32, minus 11, sorry. So this looks a little bit better. My throat is still getting the COVID treatment in some cases, I'm sorry. But you will see that we are approaching a little bit of a green here, and the same thing with the free cash flow. Margins seem to be becoming a little bit better. The growth is becoming a little bit better, yet still we're far from what we'd like to see. However, we can make some assumptions and see what it could make sense for this company to invest in. So, the revenue growth that we're going to go for something that's relatively high but not excessively high. So 20, 22 and 25, let's just say. And the net income margins, again over here, we're looking at negative territory. So I'm going to go marginally positive. This is what I have to do because right now I don't have positive margins to compare with at all. All of these have been negative. So going towards marginal profitability is already a leap of faith over here. The free cash flow margin, again, I cannot really use these values because we're talking about negative values, negative net income and negative free cash flow for the previous years. Yet I will go with something that's fairly typical. Maybe 70, 80, 90% of our net income converts to free cash flow is what we're saying. And the 13% annual return is what I typically want to be making at least. And if I hit calculate here, let's see what we're getting. Now you will see that using these projections here, which are a little bit, they're a little bit aggressive, but they could happen for sure in the next 5 years. I wouldn't be surprised. Then we are looking, let's just say for this one with a net income margin of 7%, we are looking at a high of 7.85, so about $8, and a medium of 4.45 with a net income margin of 5% and this kind of revenue growth, 22. So myself, I would be relatively comfortable with adding some NIO to my portfolio, probably around the $5 to $6 level, and that would even that would be a bit of a leap of faith. But then again, at that moment, we are having a company that is approaching its actual profitability, and it's not that far from fair value over here. And this is why I would potentially think about adding NIO to my portfolio, and I may actually do that if it reaches probably $4 or $5, maybe around these levels. I think it would make a ton of sense. But before that, I think it's still overvalued, and it's still gonna take a little bit of faith to actually add over here. You would have to get much better projections in order to justify this price. So I would probably like to avoid this at 13.7. But I feel that there is a real potential for this one to go down even more, and basically go down 50% is what I'm saying, even more than 50% in order to reach $5 or so. And in that case, I could really see myself adding a little bit. And nice thing about this company, at least for me, I really love their cars. I have been looking at their line, really like the way their cars are looking, but that doesn't mean much. I mean, I like Tesla as well. It helps though, because you are looking at a company that can potentially sell a lot, because they have been selling a lot already, and their cars look nice. So that's a good thing to see. And it's nice to like the product, but we always want to adjust that to actually align that with what the company is doing financially, not just buy because we like what we are saying. Very important. And so this is why I wanted to make this video. I think this is a very interesting video actually to go through and kind of analyze for NIO, because while it may not be at the level where we want to be buying it right now, it's actually potentially getting there. I mean, today it lost 1.20. And in this current market, I wouldn't be surprised if it loses 30-40% maybe the next 2 or 3 weeks or so, even. I wouldn't be surprised at all. So I would be ready if that happens and it goes again much lower. Of course, I would still need it to go much lower. But if that happens, then I will be around, and I may actually even make another video to talk about it with you guys. And let me know what you think about NIO. Are you a buyer? What are you thinking about the company? Leave a comment below and explain, please. And if you are not a subscriber, consider becoming one, and please leave a like, because that really helps a lot. And if you are interested in this kind of analysis, you can always become a Patreon. You can find the link in the description box below. And when you become a Patreon, you get access to this tool for free. Basically, you get unlimited access to this tool. You can do all sorts of analysis about any company that you want to. And this current market, I think taking a look at a lot of different companies can really pay. This is the time to actually buy, not when the stocks are actually higher. These days, when everything is down, this is when you buy. And thanks for watching again. I'll see you in the next one. In the meantime, take a look at this video that I made earlier, and in this one I'm discussing Rivian, a very well-known company that has been the talk of the town for a long while. Let's see if it's an interesting addition to a portfolio right now or not. And thanks for watching. See you soon. Bye bye.